Welcome to this explainer. Today, we are tearing into a seriously mind-bending contradiction sitting right at the heart of Home Depot's recent quarterly earnings report. It's a paradox, and honestly, it tells us an incredible amount. Not just about America's biggest home improvement retailer, but about the true state of the American consumer as a whole. But to really unpack it, we've got to look way past the surface-level headlines.
Let's start with the big one, the number everyone immediately notices, $41.8 billion. That is Home Depot's quarterly sales. Just to put that sheer scale into perspective for a second, that is literally more than the total annual GDP of several small countries, and they generated it by selling lumber, paint, and power tools in just 3 months. And what's really wild is that year over year, this massive revenue number represents a solid 4.8% increase. For a giant company like this, growing at almost 5% sounds like an absolute unequivocal win, right?
But you see, here is where we hit a massive wall. The glaring contradiction is this. While those top-line sales grew by an impressive 4.8%, their earnings per share, or EPS, actually fell by 4.3%. And this is the core detective mystery of our explainer today. How on earth did America's largest home improvement retailer manage to sell billions of dollars more in product, yet somehow end up making less money for its shareholders?
So to figure this out, we need to talk about earnings quality. This is basically just a company's ability to actually convert that massive top-line revenue growth into bottom-line profit. Because let's face it, anybody can boost sales if they just spend enough money to do it. But Home Depot's net income actually dropped by 4.2%. That gaping divergence between growing sales and shrinking profits makes Home Depot a really complex earnings quality story, rather than just a simple growth story. Revenue at the end of the day isn't profit.
Section 1. Transactions versus ticket size, uncovering consumer clues. Let's look closely at what the American consumer is actually doing once they walk inside Home Depot's doors to figure out what's causing this disconnect.
And this right here brilliantly illustrates our second major paradox. During the quarter, Home Depot recorded over 391 million transactions, but overall customer visits, the actual number of times a register rang, dropped by almost a full percent. Yet, the average ticket size actually went up 2.3% to almost $93. So fewer people are walking through the doors, but the ones who do show up, they're swiping their cards for more money every single time they check out.
It really boils down to this. The consumer may not be disappearing, they might just be getting a lot more selective. U.S. comparable sales were up to 0.4%. Now that's not explosive, but it's not a total collapse either. People still absolutely need to buy essential repair parts, right? If a pipe bursts in your basement or a window shatters, you're fixing that today. But that massive $20,000 dream kitchen remodel? Yeah, consumers are deciding that can definitely wait.
Section 2. The mortgage rate connection, the macro suspect. To understand exactly why those massive, highly profitable projects are being delayed, we have to shift our investigation to the macroeconomic environment. Mortgage rates. They have an incredibly complicated relationship with renovation demand. It's really not a simple equation of high rates are bad, low rates are good. It's like a giant puzzle. On one hand, high rates mean fewer people are moving. That reduces housing turnover and effectively kills those immediate, large-scale move-in renovations that new buyers almost always do. But conversely, high rates also trap people in their current cheap mortgages. And since they aren't moving anywhere, eventually those trapped homeowners might decide to just say, you know what, let's just upgrade the house we already have.
Section 3. Where did profits go? Investigating the margin squeeze. So consumers are spending a bit more per ticket and total revenue is up. We know big projects are delayed due to rates, but the sales are still there. So who or what killed the earnings per share?
Well, the culprits are margin pressures. A massive retailer can absolutely sell more products without generating proportionally more profit simply because the machine costs a lot of money to run. You've got labor costs ticking up, transportation getting pricier, the actual merchandise costing more, and borrowing money, that's more expensive too. Plus, Home Depot is making strategic investments to upgrade their supply chain. Every single one of these factors takes a bite out of every dollar earned. So that great 4.8% increase in sales, it was completely eaten up by these expenses, driving the net earnings right down.
Which leads us to a massive question. This is the ultimate test for the company. We already know they can grow revenue. I mean, $41.8 billion proves that beyond a shadow of a doubt. But as we look to the future, the real metric of success, the one that is actually going to determine their long-term value, is whether they can convert that top-line revenue growth into actual earnings growth.
Section 4.
Forecast and investor risks. The path to fiscal 2026. If we want to know if they can pass that ultimate test, we need to analyze management's outlook and how investors should weigh the risks ahead.
Let's look at management's own forecast for a second. Total sales growth is expected to be between 2.5 and 4.5%. Meanwhile, comparable sales are barely growing at all, expected to sit somewhere between 0 and 2%. And that absolutely crucial diluted EPS growth, just 0 to 4%. What this clearly tells us is that management is battening down the hatches. They are preparing for very gradual growth, and they are absolutely not forecasting an immediate, explosive housing boom.
Now, in the meantime, there is a very strong draw for income investors: the dividend. Home Depot offers an annualized dividend of roughly $9.32, which breaks down to about $2.33 per quarter per share. It's a fantastic incentive that basically pays you just to wait. But you've got to remember, an attractive dividend alone does not erase underlying business risk. You can't just buy a stock for the yield and totally ignore the health of the company.
Which brings us to a really crucial framework. As an investor, you have to evaluate 3 separate pillars together to really understand the opportunity here. Step 1, you have the dividend, providing that steady cash. Step 2, you need to see actual earnings growth, which, as we've just seen, is under intense pressure right now. And step 3 is valuation. The absolute strongest long-term setup for an investment only happens when all 3 of these pillars are working together in perfect harmony.
So basically, we're looking at 2 totally divergent paths for Home Depot's future. The bull case is that housing recovers. Those millions of homeowners who delayed their massive $20,000 kitchen renovations, they finally pull the trigger, leading to larger tickets and a massive acceleration in EPS growth. The bear case, on the other hand, is that mortgage rates stay restrictive. Consumers stick to buying the bare essentials only, transaction growth stays sluggish, and Home Depot just keeps generating huge revenue without actually producing earnings growth.
And that leads right into the biggest mistake an investor can make: the valuation trap. You might naturally assume that because Home Depot is a massive, incredibly well-run company, it's automatically a great investment. But the stock market is a forward-looking machine, right? It prices in expectations. If everyone on Wall Street already expects a housing recovery, that optimism might already be fully baked into the current stock price. A great company can still be a poor investment if you buy it at the wrong price.
So, to avoid that trap, I'm handing you the ultimate financial magnifying glass. Here's your 7-point checklist to monitor if Home Depot is actually preparing for the next boom. Watch sales to see if they hold that 4% growth. Watch comparable sales and transactions to see if they can reverse those sluggish trends. Keep an eye on the average ticket to see if it pushes past $92.76. Monitor operating margins and EPS to see if profitability finally bounces back. And lastly, watch for housing turnarounds. Look at macro indicators like home sales and consumer confidence.
Because at the end of the day, Home Depot is navigating a highly difficult economic environment right now, and they are just waiting for a massive catalyst. They don't need Americans to become financially reckless. They just need them to feel confident enough to start those postponed high-dollar projects. So this entire $41.8 billion mystery really comes down to this one ultimate question: when does housing turn? Watch that catalyst, and you'll know exactly where Home Depot is heading next.